Okay, fun thing. I just found out today that I can hide myself from these PowerPoints. So if you don't want to see me, let me know and I'll take myself off. I'm just kidding, but um, in all fun and fairness, I want to remind you that this chapter that we're working on is pretty important. If you plan on taking the auditing portion of the CPA, it can be very difficult to. It seems as you're easing it, reading through it, it seems pretty easy, but once you start looking at matching up the different concepts, it can be quite challenging. So I encourage you not only listen to this chapter as I lecture, keep it for later use, but also go in and do the practice in your book. I did the practice before I started this lecture, and there were a few things that even I had forgotten from the concept. So it was good to be reminded and to get that practice in. So we're going to look at solving the ethical dilemma. One of the things that I ran into when I was preparing for this lecture is the fact that encourage you to look at the ethical dilemma as if you are not in the dilemma yourself, but look at it in the way someone completely removed from the situation would look at it. And sometimes that means taking yourself out and maybe even consulting people that are not involved in the situation. It's a great way to resolve ethical dilemmas because often they're fraught with gray areas and intertwined problems. So anyway, in resolving it, we identify the problem, identify the courses of actions, look at the constraints, analyze the effects of the possible courses, and then set the best course of action. So okay, fun thing. I just found out today that I can hide myself from these PowerPoints. So if you don't want to see me, let me know and I'll take myself off. I'm just kidding, but um, in all fun and fairness, I want to remind you that this chapter that we're working on is pretty important. If you plan on taking the auditing portion of the CPA, it can be very difficult to. It seems as you're easing it, reading through it, it seems pretty easy, but once you start looking at matching up the different concepts, it can be quite challenging. So I encourage you not only listen to this chapter as I lecture, keep it for later use, but also go in and do the practice in your book. I did the practice before I started this lecture, and there were a few things that even I had forgotten from the concept. So it was good to be reminded and to get that practice in. So we're going to look at solving the ethical dilemma. One of the things that I ran into when I was preparing for this lecture is the fact that encourage you to look at the ethical dilemma as if you are not in the dilemma yourself, but look at it in the way someone completely removed from the situation would look at it. And sometimes that means taking yourself out and maybe even consulting people that are not involved in the situation. It's a great way to resolve ethical dilemmas because often they're fraught with gray areas and intertwined problems. So anyway, in resolving it, we identify the problem, identify the courses of actions, look at the constraints, analyze the effects of the possible courses, and then set the best course of action. So we're going to look at this ethical dilemma with Gary Watson, a graduating business student at a small college who's currently interviewing for a job. Gary was invited to both Tilley Manufacturing Company and Watson Supply to travel to a nearby city for an interview. Both companies offered to pay Gary's expenses. His total expenses for the trip were $96 for mileage in his car and $45 for meals. As he prepares the letters requesting a reimbursement, he is considering asking for the total amount of expenses from both employers. His rationale is that he had taken separate trips. Each of employers would have had to pay the amount. So one of the things I run into is obviously that's unethical. We would only report the expenses we used. It was up to Gary to make the same trip, and any outside party would definitely have probably gone with the same thing, and I'm sure you would have too. One of the things that we run into with the need for professional ethics is we have a responsibility to the public. So that is one of the things that I read in your text is that the words credibility is what we have to offer. That is our product as a CPA, and it's a very complex situation because pronouncements, the step-by-step process of making these decisions is often navigated through quite a big, large body of knowledge. And so they have a code of professional conduct out there that's basically designed to give you guidance and rules of performance and professional responsibilities. And there are, the code has several sections. The first one is the principles of the code, the rules. The principles, you know, the difference between principles and rules based. The principles are the overarching goals. The rules are the rules within that. And then interpretations give you more guidance as to how you would treat certain scenarios. And then there is other guidance and definitions uh, and pending revisions and that sort of thing that go on with the code of professional conduct. So again, here's your hierarchy. The framework is your principles. The rules governs your standards, and then underneath that are interpretations, which are constantly giving you application. Now, here is the actual code of professional conduct and how it is set up. So the preface of the conduct has the overview information, the terms, non-authoritative guidance, and new revised pending interpretations. So the stuff that is coming up in the code of professional conduct as things are changing would be at the preface. The things that are changing, new things in review. Part 1 is for members of public practice. So those are the ones that are out there and are, you know, CPAs, so to speak. And part 2 is the members in business, all right? And then the part 3 is for those who might be retired or unemployed. And one thing that I might bring up is part 3, their main responsibility. Of course, part 1, you're responsible for everything. Same with part 2 for the most part. Specific rules of conduct, but for the most part, it's pretty close to members of public practice. Part 3, other members, those who are retired or not employed at the time, are only responsible for discreditable acts. Okay, so the purpose of the conceptual frameworks is to address situations that aren't in the Code of Professional Conduct. All right, so if it's not in there, then we would use the conceptual framework. And to look at the threats to compliance and with regard with compliance requirements and available safeguards. So safeguards are in place to keep things from going too far or to trigger an action. All right, and again, they have 3 conceptual frameworks for CPAs in public practice, which are threats to code compliance and independence, and then the CPAs in business are only required for threats to code compliance. So the thing about independence, and I just want to circle this right here, independence, particularly for those in public accounting, is something that's very, very important and relevant, especially with regards to auditing, because again, we talk about relationships, and I've made the Kevin Bacon joke several times, but this becomes a problem when people have conflicts of interest. Okay, so let's look at those conceptual framework threats. The first one is called adverse interest, and that means that a client is litigating against a CPA. So if a client is in active litigation or is pending litigation, then your interest in the client or your engagement with the client is a problem. In that case, you should engage with another firm. Advocacy threat. So if a CPA comes in and endorses a specific client product. So here's a situation where your client is a software company and they produce tax software, and you also do taxes on the side, and you come in, the person comes in, some of your tax clients come in and say, hey, I'm thinking about getting a tax software to monitor my stuff all year. What do you recommend? And you're like, oh, well, I recommend this software. And in the back of your mind, you're like, well, this is my client's product. So not necessarily a good idea. Familiarity. So if you have a close friend that's employed by a client, and this gets really sticky because we all play golf and we all have relationships with people, but you have to be kind of careful about your familiarity with a client or your friend's familiarity with a client if you're auditing that client. So for example, you don't want to be too tight with clients. You want to kind of remain that professional line. So the management participation. Okay, so CPAs are not designed to go in and manage a company. And that gets kind of sticky because CPAs naturally have a lot of knowledge of business, but they should not be running the business for the client. That gets kind of sticky. So for example, if a manager, and I'm just spitballing here and using a basic analysis. Let's say a manager decides they want to go on vacation and they run a small car dealership and they don't have anyone to take over while they're gone, and they ask the CPA to come in for a couple of days and just run the business for them, or make their bank deposits or that sort of thing. Because obviously CPAs are trusted people, so that would be a natural inclination. But you can't do that. You cannot run the company that you're auditing. Self-interest. So this would be like if you had owned stock in a company and you were auditing them and then turned around, auditing reported earnings, and you knew that if the earnings came out a little lower, your stock price was going to lose value. So you definitely don't want to be on engagements where you are you have a financial interest in how the engagement turns out. Self-review. So a lot of times a client might reach out to you and say, oh, I've really got this sticky transaction with, a very sticky, how do I record this? Should I record this as a sale? It's the end of the year, and it gets very difficult, particularly in complicated products like software. So they may want to come in and say, hey, what do you think I should do? Should I record the sale or should I record it? Wait till you can't make that decision for the client. That is the client's decision, and you should not be doing that on the reg, or if at all. Undue influence would be if you happen to have a very difficult client and the client basically threatens you and says, hey, guess what? If you don't give me an A+ on my audit, I'm going to fire you. So just keep that in mind while you're counting my inventory and testing my internal controls. And that's a big no. The client is not allowed to do that, particularly with a publicly traded client. The PCAOB has a ton of rules because that's kind of what got him. Okay, so let's look at the safeguards. The safeguards are created by profession, legislation, regulation, to continuing education requirements, and call for independence and ethics. And these items are implemented by the client. So if the client, the tone at the top is something I've heard over and over, and that is the client on board with the accounting procedures? Is the client trying to do the right thing? Is the client, buying into the process? Internal control and not cutting corners and not being a bully, and also has a focus that basically trickles down to everybody within the firm or within the concern. And then the CPA firm also implements these safeguards by trying to implement and monitor engagement quality control, and that comes back to educational requirements, competence, due care, and that sort of thing. Okay, so here is a little framework, and this kind of goes through how to deal with this particular circumstance. There's like a little flow chart, so you can walk through here. If it's directly addressed by the code, yes, then you just follow the code requirements. If not, then you look at if it creates a threat to compliance with the code. If it doesn't, then you can go ahead and do it. If it does, then you have to look and see if the factors, including existing safeguards, reduce the risk of non-compliance. If they do, then you can go ahead and provide the service. If you can't, then you shouldn't provide the service. And I would think if you get down to this level, you really should be kind of thinking about whether or not you want to do this job or not. So here are the principles of the code. The first is the responsibilities of the CPA. The idea that the CPA is to act in the public interest with integrity, objectivity, and independence, due care, and also there is the scope and the nature of the services the CPA provides. Now, this is a list of the rules, and these are in order. They're discussed in the text. And then, of course, someone said integrity and objectivity actually comes before independence, but these are the list of the rules, so I would go through and read about each and every one of these within your text. Okay, so we talk about independence, and independence of mind is basically the idea that the CPA is able to conduct their audit engagement in a way with professional skepticism and free of things that might compromise their professional skepticism and independence. Independence of appearance is kind of similar, but the idea that the actual activities and appearance of the firm would not give rise from someone outside of the firm to appear to impair the independence. So the way that they handle themselves and within the engagement. Okay, both are required. Okay, so here's the framework for independence. And again, they have the framework when the code doesn't direct directly address the threat. And if they don't directly address the threat, that flow chart that we had, the auditor considers whether or not the safeguards exist to eliminate the professional threat of independence. So if there is a situation that doesn't directly address it, then they have to go back in and kind of look at the situation and see if there's something that will keep them out of trouble with safeguards. And the idea, again, is that a reasonable third party, aware of all of the relevant facts, someone that's not on the engagement, that's not with a firm, would conclude that there is, whether or not there's unacceptable threat to independence. So here are some threats to independence. I was trying not to name these earlier. It's so easy to want to just go directly to this because it makes so much more sense. So these are all the different threats. So the first one is adverse interest. Again, that's when there is a relationship, there's litigation. Advocacy of the client. The client or the CPA promotes something, like for example, promoting securities as part of an IPO. Familiarity. The spouse holding a key position. Now, I looked at some of the questions, just in some of the review questions. If the spouse does not hold a key position with a client, like someone who is, and again, they said an admin assistant, but then I kind of thought to myself, well, some admin assistants run the whole place, so that's kind of a shaky one. But if the spouse is not a management key position with the client, then they aren't familiar. Financial self-interest of the CPA, so if they own stock. Management participation, the CPA serves as an officer of the client. Self-review. So if the CPA provided consulting services that relate to the financial statements and then turned around and audited them. And then finally, undue influence, which would be pressure from the client to reduce the audit. And just like other threats, the safeguards that are in place are created, like continuing education, effective board of director oversight, and stressing the importance of independence in training programs. So here's another summary. Using independence, same thing. If the code doesn't address it and it might impair it, then independence. If the code does not directly address it, the relationship does not create independence impairment, then it's not impaired. If it does create independence impairment, then you have to do the qualitative, quantitative factors, and then kind of go through this as we. Okay, so now let's get to the heart of the matter. Covered members. This is kind of an important one. So the idea that the individual has certain areas of independence, but the firm itself may not have all individuals independent of the job. So if not all individuals in the firm have to be independent on the job. So let me say that again. Not everyone, if you have a large firm, like a PwC or KPMG, not every single accountant in the entire firm is going to be able to be independent from another company. They may own some of the stock. They may not be able to audit because they own some of the stock. So there may be a situation, for example, a stock like Facebook. There may be thousands of people in the firm, a large firm, that own stock of Facebook, and then they have independence impairments. But not everybody in the firm owns Facebook, so they would pick the ones that don't and that don't have any relatives that own it and go from there. So covered members include staff working on the engagement. These are people that are covered, that are required to be independent. They're called covered members. An individual who may influence the attest engagement. A partner in the office in which the partner in charge of the attest engagement primarily practices. So if you have a partner where the partner in charge of the audit is in an office where they practice, then they have to be, they're considered a covered member, have to be independent. Partners or managers that provide a specified amount of non-attest services. So for example, if you've got a situation where half the firm audits and then on the other side of the country, someone originally did some consulting work or did some accounting work, then we have a problem. A public accounting firm and its employee benefit plan. Anytime you see, okay, so like I did a few practice questions. Anytime you see the word employee benefit plan in the CPA test, just let your feelers go off. And in your chapter, employee benefit plan is kind of important. So anyone in the employee benefit plan is a covered member. Okay, an entity controlled by one or more of the above, any entity. Okay, so independence requirements for all partners and staff. Okay, so here's a number you need to remember is 5%. So no partner or professional employee may own more than 5% of the iTest client's outstanding equity securities. Okay, so no partner or professional is a combination of all such persons may not own more than 5%. 5% is your benchmark. No partner or professional employee may be a director, officer, employee, promoter, or trustee of the client. All direct financial interests are prohibited regardless of the amount. A material indirect financial interest is prohibited. So when you see the word indirect financial interest, make sure it's material. And I did a question in your book about 10 shares of stock. And in my mind, I'm like, oh, that's immaterial. But then in the back of my mind, I thought, well, what if there's only 11 shares total? So if they don't give you the total number of shares, just assume it's material. It's a sneaky question. Gifts from clients also may impair independence. Golf clubs, golf trips, vacations, anything too outrageous. One of the things when I was doing the review is they talked about an office running late and they bought a pizza, late night on an audit, and the client brought in, shared some pizza with them. That's not really going to impair independence. Just heads up, pizza is a safe space. Okay, additional financial interest. So the independence requirements for covered members. Here's an example of a direct financial versus an indirect financial interest. A direct financial interest is an investment in the client, such as owning capital stock or providing a loan. So if you're loaning money to the client, you have a direct financial interest. Okay? There's nothing like this that's allowed for a CPA to maintain independence. So if the CPA firm lent somebody, say a CPA is very wealthy, and they lent or is on whatever, owns a portion of a bank or whatnot that lends the client some money, you've got an independence problem. You shouldn't be on that audit. An indirect financial interest is an investment in a mutual fund, which in turn owns capital stock of the client. So let's say we got a mutual fund. We all have retirement funds, or maybe we don't. If you don't, you should definitely start one. And that mutual fund has hundreds of stocks, and somewhere in there, you just happen to roll in a little tiny hundredth of a portion of Facebook, and you're on the Facebook audit, and you probably don't even know that they've invested in Facebook this week. That's immaterial. Okay? So the word covered member is super important. So if you're studying for the CPA, again, I encourage you to listen to this, read this out loud, practice it. It's not as easy as it looks. It's one of these sneaky things. So a CPA partner, employee, or investment club and of such partners and employees own more than 5% of clients' outstanding equity securities or such ownership interests. If they are a covered member. For the covered member, the independence is impaired. If you're not a covered member, it's still impaired because somebody owns more than 5%. All right? So you don't have to be a covered member or someone on the engagement. You're still impaired. A CPA partner or employee is simultaneously associated with the client as a director, officer, employee, promoter, trustee. Everybody's impaired, whether they're on the engagement or not. The CPA has a direct or material indirect, remember the material indirect, interest in the attest client. For a covered member, if it's material, even if it's indirect, let's say that mutual fund now owns 50% of Facebook. Now you've got a material problem, right? Then you're impaired. The firm independence, though, is not impaired if the direct is less than 5%, as indicated in number 1. So if it was less than 5%, then you're good to go. Excuse me. The CPA has a material joint, closely held investment with the client. Everybody, once again, is impaired. So here's what I would say. If you have some sort of financial out there, and it's pretty substantial, assume you're impaired. Just go ahead and assume it, and then if you double check, go back and look at your scenario to determine that you're not impaired. But err on the side of thinking it's probably best to think, particularly if you're doing this in a standardized test scenario, and one of these questions comes up, assume you probably are impaired, and then look for ways that you wouldn't be impaired. Okay, so now we come back and we look at the effect of independence on family members. Okay, and so we all have family members. There's a little saying that says, blood is thicker than water, right? So it's important to understand how our family members play a role in firm independence. So a covered member's immediate family members must, in general, comply with the independence rule. So if you have, for example, if you have a family member that has more than 5% of that direct stock, then you have a problem. When an immediate family member violates the independence rules, independence of the covered member is impaired. So for example, you can't just say, okay, well, I don't own 5% stock of Facebook, but my wife does. Nope. Or my husband, or my son or daughter. One of the little tidbits was client relatives, okay? If they have a client relative, which is a parent, sibling, or non-dependent child, and they are in a key position or have a material financial interest, and the accountant has knowledge, that is something that they added in the book that I didn't know about. I just assumed it was all, but you actually have to have knowledge. That's kind of iffy because, of course, the first thing you're going to do is deny. But I would watch that carefully. The other thing is independence, again, is only impaired when a reasonable person aware of all the facts would conclude that this is an unacceptable threat with other relatives and friends. So it's only if your best friend owns 50% of Facebook and you're on a Facebook audit and it's clear that you all spend a ton of time together, then a reasonable person may say, oh, well, they're best friends. This all comes into whether or not how you testify at litigation, and I promise you those tough lawyers are probably going to find every single thing they can if the CPA is being sued, and they've got some really good lawyers, so they'll be looking at your friendships and this sort of thing. An individual has primary responsibility for a key person. Who is a key person? That's someone who has primary responsibility for significant accounting functions. So I was kind of thinking of that admin again, because sometimes the admins are the primary responsibility. And then they have the ability to exercise influence over the contents of the financial statement. So these are members of the board, CEO, president, chief financial officer, operating officer, the general counsel, the lawyer, the chief accounting officer, controller, and on it goes on, okay? So your admin could be considered a key person. So here are the things that you're not supposed to do if you are an auditor or doing an audit. You cannot do your client's bookkeeping. You cannot design your client's financial systems design and implementation. For example, if you use an ERP system, you can't be the one that designs it. You can't appraise the client's or value the client's property or machinery. You can't provide actuarial services. Internal audit, they can't, if your internal audit is outsourced, you can't provide that either. You can't be the manager or the human resources officer for the client. You can't provide investment service, and you can't provide legal or expert services for certain tax services. If you're an auditor, you cannot cross these lines. You're not supposed to be doing. All right, so let's go into, and I know this material is kind of dry. I hope the background music kind of spices it up a little bit for you. But it's just stuff, guys. It's just, ladies, friends, it's just stuff you have to know. I'm sorry. All right, integrity and objectivity rule. This applies to all members of the ICPA and all the services applied by CPAs. So some of the violations include making or permitting or directing another to make material incorrect entries, failure to correct financial statements that are material false, and signing or allowing someone to sign something that is materially false has misleading information. And the general standards apply to all CPA services, and they have to comply with professional competence, due professional care, planning and supervision, and provide sufficient relevant data. Now, I'm not going to read the compliance standards rule. I did practice this in your book with some of the problems. It's a lot. It's really easy to get confused over who has authority over what. There are so many technical bodies. I, at the very minimum, would know what the AICPA does, the PCAOB, the Federal Accounting Standards Board, the Government Accounting Standards Board, the International, well, I mean, at this point, you might as well know all of them, but I definitely know some of the main functions of the AICPA and GASB, FASB, IASB, and PCAOB. But trying to understand what they all do, it's a lot. I get it. Okay. The accounting principles rules. So what we're following in the audit is the accounting principle rules designate generally accepted accounting principles. And then I want to move on to acts discreditable. And there's a little sticky question in here. Obviously, all CPAs are covered under acts or are subject to the Acts Discreditable rule. But the ones that are subject to just this rule only are the ones that are retired or unemployed. So, and then there's another thing that you can't do. You can't hold the client records hostage. If the client doesn't pay you, there are some things you have to give them back. Now, if you go out and prepare them for the client, then you can hold on to them until you get paid, or if they're incomplete. But if the client gives you, like, I'm just thinking off the top of my head, the client gives you last year's tax returns printed out and it's the only copy, or they give you a copy of the deed or something, and it's their only copy, you can't hold, or their general journal, and that's their only copy, especially back when they used to do this on paper. You can't hold on to it and not refuse to give it back, even if they don't pay you. If you make it, you get to keep it though, to get paid. And supporting records, you can give it to the client. So, for example, if you do the adjusting entries, but you can't hold them back if the client hasn't paid you. And then your working papers are your working papers unless the law tells you otherwise. So you can hang on to that stuff. Okay, so when I got to this slide, I've actually had to do this slide twice because I started to read it and I'm like, this sounds completely wrong. And then I actually did what all good accountants should do, is I reread the statement. So let me explain contingent fees. Contingent fees are fees that are given upon the performance of a certain objective. So if you can't perform the objective, then you don't get the fees. I'm sure you've heard of lawyers taking cases on contingency. If they don't win, you don't have to pay them. The accountant, an example of account contingent fee is, for example, if you prepared a business plan for a client and you were paid on the contingency of sale of their securities or for their company. So you can charge contingent fees as long as you don't do any of the following services for the client. And one of them is you can't audit the client. You can't prepare a compilation of financial statements that are going to be used by a third party, like a bank. And you can't do an examination of prospective financial information for a client. So here's something. Contingent fees are not allowed to prepare an original or amended tax return or claim for a tax refund. So you can't charge contingent fees if you end up saving the customer money on their tax return. And the PCAOB for public companies, that's a big no-no all around. Totally. Okay, so commissions, referral fees, and advertising rules. As with contingent fees, those fees are only allowed for the non-audit attest client. So for example, if you have some sort of referral fee, somebody comes in your office, they have a small business, they leave their card on your desk, and then they give you a referral fee if you happen to refer some of your traffic your way, then that's just not something you should be doing. Normally, it's kind of a little iffy, but you definitely cannot do that if you are auditing said client. You can advertise as a CPA. There's some specific advertising. I'll go back and reread the book. You can advertise as long as it is not false, misleading, and deceptive. And that also comes into the naming of a CPA. And there's a section of that in the code. Also, let's talk about confidentiality. So you shall not share confidential client information without the specific consent of the client. Okay? However, you cannot directly also disclose illegal acts by the client unless you have a legal duty to do so. So if a client is committing something or has for example, a employee that commits fraud, you can't go out and let people know that unless you're called by the court or you're ordered to do so. Confidential information is not privileged. That means it can be compelled by court of law. Okay, so the name. We talked about the naming. You can practice in any legal business form, and you can use a fictitious name as long as it's not false, misleading, or deceptive. Or, for example, a sole proprietor practicing in a partnership name. So here's an interesting example. Let's say your name is Peyton Wendell I'm trying to think of the last name, Clampett. and you'd like to go by the initials PWC. You can't do that because there is the PWC. So you have to be kind of careful about that. So just kind of careful with your name. Okay. So the last little thing is the alternative practice structures. You can read through that. It's and there's some information on it in the book. And there's different ways you can go in and work that. And then last but not least, the applicability to members in business and others. So everyone who's in business has applicability to the entire code of conduct. If the others are people that are retired or unemployed at the moment, they are applicable only to act creditable if they're continuing their licensing if they want to keep their license current. Now, the IIA, the Institute of Internal Auditors Code of Ethics, changed to the color to kind of brighten up this lecture. Internal auditors are expected. These are the people on the inside. We've been talking about everybody on the outside, CPAs. Internal auditors are also expected to uphold the following principles: integrity, objectivity, confidentiality, and competency. And it goes through the integrity. I want to make this bigger. Maybe I will fix the slide for next year, but I'll read it out for you. They have to do honest, diligent, and responsible work, observing the law and disclosing anything that is required by the law in their professional, and they should not be party to any illegal activity, and respect and contribute to the legitimate ethical objectives of the organization. Part 2, this one came in a little bigger. They cannot participate in anything that is presumed to impair their unbiased assessment. So they cannot go in and do something that's going to make them look unbiased within the organization. They can't accept anything that would impair their professional judgment, and they have to disclose anything that might distort the report of activities under review. They also have to maintain confidentiality and not use the information for personal gain, and they should only engage in those services that they have the skill and knowledge to do. They should perform internal auditing services in accordance with standards of professional practice of internal. Okay, so this completes chapter 3. lecture. This is a little bit of a, but here's the deal. Save this lecture if you're studying for the CPA within the next 3 to 5 years, because they will come back and help you. You can listen to me anytime. And this comes right off the code, and I have seen this stuff before in exam review packages and samples questions on the AICPA website, so I highly encourage you. Also, if you have a chance to do the reading practice questions, the Learn Smart questions, go ahead and do them. It just helps fuel your knowledge. And that's what we're all here for. So have a great rest of your week.